Hello, everyone. Okay. So the economy is transforming in terms of numbers. Almost more than 70% of the global economy is now in the form of the services. So when you offer services to the customers, the importance of the human resource interaction becomes more pronounced, and their skill set, their engagement, their retention, the organization is becomes more and more important. And since the organizations, they survive, they basically exist for a certain purpose, which is to deliver performance in order to add value to the community. And in order to achieve the organization performance objectives, people have to perform. Now, you must have seen that when it comes to measuring the tangible aspects of the performance in terms of delivery or the products and the services, everything is quite measurable in numeric form. You have an MIS at the end of the day, not even on monthly basis. Every day you have a certain clear deliverables, may it be telecom sector, may it be production sector, may it be a banking sector, may it be a health sector. You have certain clear numbers at the end of the day. However, when you relate this performance aspect to the human or the HR performance, HR means not the HR department, but the workforce performance, there are a lot of issues. And those issues are that there's a line of sight between the organization KPIs and the individual KPI is blurred. And sometimes there is no measurement. Or even if there's a measurement, there's an excessive focus on the measuring the activities and rather than the impact. At times, the performance is based on the descriptive statements, or you say the pretty phrases rather than the outcomes. And the passing score, with the help of which you can determine that what is good or what is the acceptable or unacceptable performance, in most cases, it's hard to substantiate. And the main concern in this entire process is that the efficiency is being measured and the effectiveness of the outcome is being ignored. Now, during our presentation, we'll spend some more time in understanding these three aspects of the performance: efficiency, effectiveness, and the outcome. Now, the consequences of this action are that at the end of the year, there's a bell curve of the employee performance. Usually, it is inflated positively, but when you relate it with the organization performance bell curve, there's a mismatch. There's an excessive focus on the exercise of doing the performance management, but as to what extent the line managers find this performance management tool effective enough to distinguish between a star performer or the stellar performer in the deadwood, that also becomes question mark. When these performance ratings are overly positive, obviously the top management does not accept, and then the people are asked to downgrade. And then there's an element of face saving between the line managers and the HR, and line managers blame the HR, and the HR people blame the line management for the downgrading, because facing the employee is little difficult. And in this process, what happens that the high performing employees feel discouraged because they feel that they're not being evaluated. And since your compensation depends upon your evaluation, so they get discouraged. People with the mediocre performance, they feel comfortable. And at the end of the day, the high performance employees, they may leave the organization because of the grievances, the loss of morale. And so the organization performance at the end of the day, because of this process, is not leveraged, rather it becomes further deteriorated. Now, in order to execute this concept, we have to have a system thinking. And the system thinking calls for an end-to-end approach. There's no quick fix involved into it. Whether you're serving in any of the sector, the performance management framework for the organizations remains same. That means that every organization has got strategic goals, that the long-term things that they wish to do into 1 to 5 years time frame. And then the strategic goals are broken down into the operational goals. Operational goals could be from 1 year to 3 years, depending upon the outlook of the organization. Generally, they're for 1 year, or you can call the business plan also, this operational plan. And these operational objectives are then assigned to the top management, and which you call the top management is part of the overall company workforce. They're also employees, and they cascade down to the grassroots level. And in order to execute that, there's an element of necessary support in the form of the job descriptions, the tools, or the coaching which is required to perform that job. It is supposed to be provided. And then before the formal performance appraisal takes place toward the end of the year, it is recommended to have intermittent performance reviews just to have a fair understanding of the performance of the employees, and if there's any gap that needs to be covered, so there's no surprise toward the end of the year. And after the performance appraisal, then there is a reward, and you can say the corrective actions. It could be in the form of the promotions, it could be in the form of the increments, or in certain cases, exits, or putting the people on probation also. So this complete cycle, it is required for effective performance management. Now, in today's webinar, we are not going to discuss the complete cycle. I wanted to give you a bigger picture. Our focus is to see and devote more time to measuring the KPIs. But the importance of this complete framework is that you have to see it in the whole context, and there's a need to align the ultimate employee performance management with the organization performance. Now, I understand that while I'm presenting, you would be having certain questions also. I would be very happy to answer your question, and please, you may like to write down your questions that I would like to tackle towards the end. Okay, now we said alignment. The word is very simple. You must have taken your car for alignment and would have seen that this process of calibration requires that all 4 tires need to be in one direction, because there are consequences of not being in the same direction, because there's an excessive wear and tear involved if the performance or the 4 tires is not mutually aligned with everyone, with each other. You must have also seen the goose flight, where there's one which is leading and everybody in the follow-up. Now, in the organization settings also, the leader of the organization is the leader, and in a good spirit, with this assumption that the leader is pursuing the organizational objective, everybody is supposed to follow. So whatever direction is important for the leader, you need to go in that direction. Whatever is forbidden, you need not to go in that direction. And you have to have an evidence. You have to have a clear numbers, evidence, with the help of which you can exactly say that I'm in alignment or misalignment. Organization KPIs usually originate at the top level. The board is responsible for approving the business plan of the organization. Then these organization KPIs are supposed to be achieved through the management. And then there are layers of management down to the lowest level of employees. So logically, there is a line of sight which is required, which means that if the board values something, that something could be quality, that something could be cost, that something could be the turnaround time, then everybody down the chain has to give more importance to that factor and should have the evidence to say that there's an alignment. Now, these KPIs broadly are defined into the 5 possible dimensions. And these dimensions are applicable in all the sectors. As I said earlier, and I'll give example also that supposedly you're serving in the banking sector. Now the banks offer various services. They offer loans, they offer deposits. So if I give an example of the loan, so their performance of that product or that particular department, which is the credit department, is assessed on the almost 5 broader factors. There could be sub-factor which in each component also. For example, it could be a number of the loans or the amount of the loans. How much is the cost of acquisition of the money that you have to pay before giving the loan, whether this is an internal or external equity. How much is the time frame to process a loan? Because if more time is involved, there's an opportunity cost, and that is counted as an inefficiency on the part of the organization. Then before you issue a loan, there's an element of compliance. That means there's a certain set of documentation which is required. And if that documentation is incomplete, then your compliance department is going to reject the applications. So despite the fact that you have a desire to provide the loan, but you would like to have an element of quality because subsequently you have to collect the loans also. To avoid default, you would like to ensure certain acceptance and rejection criteria. And finally, when somebody avails a loan, eventually the performance of the loan, how the person is being treated, as to what extent it has served the purpose of that person. So either the person is going to get into a repeat business or refer this service to somebody else, or may also close the dealing with the business if the service is unsatisfactory. Now, this I just give an example of the banking sector. You can apply in the telecom sector also, that when you offer certain services, for example, a package of a mobile package, so you would like to see that how many are the subscribers, what is the cost per subscriber, how much is the talk time which is being used by a single subscriber, or what kind of basic documentation is required to make somebody a subscriber, because in the absence of, for example, CNIC, you would not like to issue a SIM to a subscriber. And then you would like the customer to be a repeat customer and refer. If you talk about any of the production in the FMCG sector, supposedly the food, or for simple understanding, a water bottle, which is produced by the bottlers. So at the end of the day, you want to know that how much is the production per day, how much is the cost per bottle, how much is the time for production, what the criteria in terms of ingredients of that product is being used by the quality control department to determine that it meets the specifications which are written on the top of the bottle, and how many are the repeat customers and who all are the dissatisfied or any complaints. So the aim of giving these 3 examples was that this is a globally consistent model which is applicable in all the sectors. There is a possibility that in certain cases, some of the aspect is valued more and there's a less emphasis somewhere. For example, some organization may be very conscious about the cost. Some organization may be less conscious about the cost, but more concerned about the quality. So whatever is important for the organization, that those are always matters of the choice. But this is a globally consistent model. And in this model, you would see that there's one single element, which is called cost, which is upfront financial matter, financial aspect. Rest, all 4 things are non-financial, but they have financial implications. For example, if there are 2 subscribers in a telecom company, one of them is using a talk time of maybe X number of hours or 1,000 hours, and the another person is using a 500 hours. So obviously, both these subscribers have a different revenue stream for the organization. So this is a financial measure. If 10 people walk in for asking for an activation of a SIM, and 8 out of them, they are rejected because their documentation is not complete. So it has a financial implication for the organization. If 10 people become subscribers, 5 out of them desert because they're dissatisfied, it has a financial implication. So what I'm trying to say that every aspect has a financial implication, but most of these implications are indirect and only the cost element is direct. Now you have to consider this aspect while developing the KPIs for the organization, because this is the organization performance measurement model, and the HR as a support function has to be in alignment. So we have to think that if organization considers something valuable, we also have to consider that valuable. And since organization develops all these aspects in numeric terms, nowhere you would find that at the end of the day, supposedly if it is a hospital sector, so people make the guesswork that, oh, X number of people came, X number of operations are done. This is the average time for an operation, usage of the operation theater. So point is that all these business indicators are measured in numeric terms. So we have to promote that psychology into the HR. Now we mentioned these 5 factors, and the 6th one was the impact, which is influenced by all these 5 factors. So if you categorize all these 6 factors, you can say that they can be clubbed into 3 main categories. What are those categories? Efficiency, where you measure the volume, time, cost. Effectiveness, where you measure the quality from the acceptance ratio, from the satisfaction ratio. And the 3rd one is the impact. Now, you would see in this model that from the business point of view, from the board point of view, from the top management point of view, the impact and the outcome is very important. And the impact depends upon the quality. The quality depends upon the efficiency. So all these aspects are not the, you can say, substitute for each other. They are the extensions of each other. You cannot achieve the impact or the outcome without having a quality, and you cannot achieve quality without having achieved the efficiency. What you have to do is that in your measurement, you have to take a balanced approach of measuring all these 5 possible aspects, but then certainly giving some more weightage to some of the areas which really deserve more thing. So I know you all are mute over here, but I can, for some time, very short duration, I can unmute and I can ask you that out of all these 5 factors from the business point of view, do you really think that outcome is most important, or you have some different view? If you want to add certain comments, I'm unmuting yourself. Anyone may like to. But please first of all raise your hand so that I can direct the conversation. Anyone wants to say something? No one? Would somebody like to share opinion that which element is most important in all this measurement framework? Imran Nabi or Farad Bukhari, any of you? Farad, can you hear?
Hello, Zahid, can you hear me?
Yeah, I can hear you.
Yes, you are very right. Outcome is, of course, dependent on all of these other factors. You're also very right that for some positions, for some departments, we may give more weightage to efficiency and or in other cases, giving advantage to effectiveness. It's the outcome that board or strategic level management is looking at.
Right. Okay. Now, anything else? Or anybody else who wants to comment? Bharat, you have some view on this? Okay, last question. Anyone else who wants to say, please go ahead. Right. So let me move on. So we were discussing that KPIs are classified into 3 categories, but you would also agree that employee KPIs are generally skewed toward measuring the efficiency, where the organization is more interested in the effectiveness and the outcome. And this framework of measuring the efficiency and the outcome is just like you see in accounting and finance. The accounting is more measuring the transactions, day-to-day activities, but finance is focuses on more on the outcome, profit and loss. And if you consider the importance or even salaries of the people who either has 2 years of experience in accounts or 2 years of experience in the finance, you would see that finance people are better rewarded. So what we understand from this conversation is that efficiency is important, but at the end of the day, the people have to be concerned about the outcome of that process. And we'll keep this framework in mind while talking about the KPIs. So the KPI word by itself is the key performance indicator. And the definition of this KPI is that the quantifiable measurement of the critical success factors that are important to the organization goals and objectives. Now here the word being used is the critical, and keep in mind that everything is not critical. So you have to be very selective in terms of identification as to what extent, at which element is more important or which is less important for the organization. Now, I'm giving you an example over here. Now, since I circulated this information about the webinar on the social media, originally I had this thing in mind that the audience would be mainly from the HR fraternity. But there was a good suggestion that line managers also deal primarily with the performance management, because HR develops policy, the execution is through line managers. So we should also welcome them. So that's why I did not discourage anyone other than the HR. So over here, I have developed an illustration, and this illustration is basically developed around the hiring manager, but I would explain it in a way that it is easily understandable to everyone, because there are certain common elements which are applicable to the even hiring manager, or whether the person is an HR or the non-HR professional. So hiring is something I think which is relevant to everyone. And I can also realize that some of you would be having a concern that my job description is not there, so how I can relate. I would suggest you to focus more on the framework and the concept, because if you are able to buy the concept, grasp it, then it should not be a difficulty to apply it in your own job description, because you understand this is a 1-hour webinar, so we have 81 participants, so 81 job description cannot be discussed practically. So we earlier talked about the volume, time, cost, quality, which is in the form of exception or rejection, and then the user satisfaction. If you see this framework, you can easily say that there are loads of things to be measured in the hiring. You can count the number of the CV, the number of the people interviewed, or the number of the people who were turned down, or the offer letters. But if you use the word critical, which means that you have to be very selective in terms of identification of the key things, then broadly, the key things are how many people have been hired, what is the cost per hire, what is the time to hire, what is their retention quality, I mean, how many of them have been accepted or rejected during the probation period. Although this acceptance rejection is there during selection process also, but we are using the word hired. So somebody who has been hired, from there onward, this is being considered. And the performance quality, so that even those people who survive the probation period, there's always a difference in terms of performance. So if you have 5 people somebody who is rating can have rating 3 and somebody can have the rating 5. So both of them, they complete probation, but there's a difference between performance. So performance quality, and we'll discuss the framework, how you can discuss the, how you can apply this framework to the for calculation purpose. Okay, till now, if somebody has got any question or the comment, so you may like to unmute yourself and quickly ask the question, and then we'll go to the calculation part, because understanding of this framework is important before we apply. So you have the freedom now to unmute yourself and ask any question that is bothering your mind. Hello. Aurangzeb, is everything fine?
Geez, that's how everything is fine, and so far so good.
ठीक है, बिल्कुल ठीक है. Let's move forward. So over here, I would like to show you an Excel sheet which describe this concept in a better way. So we talked about the hiring, and we talked about 5 things: the volume of hire, the cost per hire, the time to hire, their retention quality, and the performance quality. So you would see over there that there is no subjective or the tricky phrases or the descriptions which are being traditionally used in the HR management. We are very to the point, number centered, and the numbers are really something which are important to the organization. You can always, see which factors are more important or less important, or maybe you want to substitute one number with another. That's always your choice, but this is the broader framework. Now, to explain it, volume of hire. What you do is that you give a certain weightage to every aspect, and the sum of the total weightage is 100%. So over here, you give 10% to the volume, 15% to the cost, 25% to the time, 30% to retention, and 20% to the performance quality. These weightages are always relative. It is your choice. What do you want to give? But always keep in mind, as I said earlier, that some of the things where you can see the quality or the impact, logically those should get the higher weightages, but it's always relative, and you have the complete freedom to choose the weightages as long as your supervisor is agreed with it. Now, before setting a target, you should get certain fast view if you have that comfort, because setting a target with some background information that what has happened in the past. For example, this tells that previous year, despite all your efforts, only 90% of positions could be filled. Last year, 90% of positions could be filled. Last year, the retention rate of the people, the newly hired people, I'm not talking about the overall retention, newly hired people was 98%. Their average performance rating. Now, how do you calculate the average performance rating? Suppose you have a rating scale of 1 to 5, and you hire 5 people. One of them gets rating 1, 2, 3, 4, 5. So you take a mean or the average of everything. That's called the average performance rating. That's a good indicator of the performance quality of the people, and obviously that is based on their attributes or the achievement of their objective, which is to be assessed by the line manager. And last year, the average cost per hire. Keep this thing in mind. All these are the mean figures, not an individual figures. Average cost per hire was 55,000, and average time to hire was 40 days. This is just a reference point. With this reference point, you now want to set an objective, and you say that your target this year, you have to hire 12 people. And once the year completed, you determine that out of the 10 people, you could only hire 10. Out of 12, you could only hire 10. So 10 out of the 12, it's 83%. And since its weightage is 10%, so you get 8.33 out of the 10 marks. Your cost per hire, the target was 50,000. And at the end of the year, with your smart hiring strategy, average cost per hire was 40,000. So you had a 20% improvement over there in terms of your cost saving. And out of the 15 marks, you got 18. Your time to hire, your target was 35 days. But with your smart strategy, you could do it in 30 days. And there was 14% improvement. So out of 25, you get 28.5. Now, you can always adjust these things. For example, your target was 35, but you actually ended up hiring in 40 days. Now you see that your achievement is reduced. Your achievement is now 85%, and 85% of the 25 is just 21. So this is how it works. Now in this sheet, you would see that there's written something plus, or the positive, 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 and the negative, negative. This shows that in certain indicators, the negative is better. For example, in the cost, you would never like to be on the very high side. Please do not take this understanding over here that lower the cost is better. No. We are doing this metrics. After having done all these metrics, you have to analyze everything in entirety. That with reduced cost, how has it impacted the quality, the performance quality, the retention quality, time to hire? If everything else is normal, then obviously this cost is good enough. But if it has disturbed other factors, then lower cost is not better. So with the help of which you just calculate the score for every component of this performance. And when you sum up all these scores, there's a called the composite score. In this case, it is 107. Or as per your organization performance management framework, every organization has got certain framework. For example, you say that anyone from 86% to 100% is called 3. It can always be organization specific. Keep in mind, this is not a flat principle. This is already part of the organization. So as per this performance management framework, which is in front of you, anyone who stands from 101 to 105 is rating 4. So you see that in this person is getting rating 4. But if any of the performance indicators changes, for example, time to hire was, target was 35 days, then you ended up in 50 days. So you will see that performance rating has automatically downgraded. It has gone to the 3. So the things are evidence-based in a way that if something improves, it translates into the better performance indicator, or it can affect positively and negatively. And that positive or not negative effect has the terminal impact on your final score. And then your rating depends upon that. This is one aspect. Second thing is that impact. We were using the word impact. Now, how you can calculate the impact? For example, over here, there's a metric which is called retention. And retention is something which is equally understandable by everyone, because this is important for the line managers also. They're responsible and they're concerned about the retention of their employees. And the HR is obviously very much concerned about it. So if we want to calculate, and let me assure you that every component in this framework can be translated into the financial outcome, where you are in a position to tell to the business that this is what is the improvement or financial gain during this year. Because what happens that when HR professionals, they approach business for certain initiatives, for example, purchasing a software, asking for money for the training, asking budget for the employee engagements, this approval is always in financial terms. But when the business asks that what is the payoff, what is the return, then the HR generally has a soft kind of return, and soft words, for example, simple retention or morale or loyalty, and not able to translate into financial terms, because of which the business people do not buy the business case of the HR. So in order to make the convincing business case, I'm sharing with you an example. Now, this example is based on an actual case study in an organization. While I was a practitioner, I have done some modification in this case study in order to make it easily understandable, so that you can clearly grasp. Now, the case study is that there's an organization, and this pertains to the situation in 2011. So they have a headcount of 1,650 people in that year. And there was a total turnover of 17% in that organization, which means that 85 people out of 165 left the organization. And out of this 17%, 14%, that makes 225 people, was a voluntary turnover, and 60% was the involuntary. Now, I'm I'm going to walk you through this number. The aim is to clarify the concept that all these HR activities are translatable into the impact. Because traditionally we think that the only indicator to demonstrate the performance of the HR is the cost. When you say lesser is the cost, that's a better indicator. No, cost is important, but you have to focus more on the payoff. What is the net gain? So over here you see that we calculated the average cost per person or average hiring cost per person, which over there was 14,855. And then we calculated that we have lost 225 people, which we have to replace this year. So there's a loss of 3.3 million straight away. Though the actual cost loss is going to be much higher because there's going to be an element of inflation. Every year is the cost of all the tools that we use in hiring, they increase. So there was a loss of 3.3 million. The training, average cost per person which was trained in the organization was 22,743. And we also, our analysis revealed that those people who have left, they had a various service background. I mean, definitely they cannot be from a uniform service group, but their average service was 4 years during the period those quite experienced people. So we calculated the 4-time cost of those people, 225 people multiplied by cost per training and multiplied by 4, it was almost 20 million rupees. So the net loss on account of hiring and training was 23.8. Now you will see an interesting phenomena ahead, because this is a cost which is upfront, can be calculated from the ledgers. It is easily available with the finance and accounts. You just pick up the figures from the ledger and multiply it with your number, you will get this cost. The next thing, which is called the hidden cost, which is quite significant, which is usually not calculated. So we determined that on an average, it takes 35 days to fill the positions. And keep in mind that there are two kinds of positions in the organization. One is called the business development position, which basically generate revenue, and other one are the support functions. Support functions do not generate the revenue, but they contribute to the revenue generation. So over there, the concept which is being used for calculation is the proxy figure. The proxy figure example is that, like, you use the per person income per capita in your economics. So if you have two people, one of them is earning 10,000 rupees, $10,000 a month, the another person is having a zero income. So the average income per capita would be 5,000, because that's the principle of the measurement, and that's the broader measurement that is used at the organization level. So using the same principle, that when the business people have the financial implication of opportunity cost of turnover, the support function also has a opportunity cost, though they do not directly contribute revenue generation, but they contribute toward the process of revenue generation. So we multiplied the average vacant period, which was 35 days, with 225 people, and average revenue per employee per day in this organization, the average portfolio of an employee of the business development was around 3 million. So which was approximately 100,000 rupees per day. So the consequences of loss of these people, because of that, you can say the unfilled vacancies cost was 787 million. Now just compare the direct cost and indirect cost. Another thing, which is a deeper analysis we did, we found that when we hire a new person, in order to become fully productive, and our productivity was defined in a way that the person had to manage certain number of the clients. I think if I recall, it was around 300 people. So with that framework, obviously 300 clients were not achieved on the first day of hiring. Usually in the first day, first month, they would be likely to achieve a target of 50 clients. In the next month, they may like to go to 150. It's not static, but this is the average outcome of the study. So in the third month, the person will be fully productive. So we determined, for example, that if the person's portfolio is 3 million and the person is able to achieve only 50 clients in the first month, so there's a loss of 2.7 million straight away first month, Next month, the person becomes 50% productive. So there's a loss of 50% revenue, and the cumulative loss of this time frame when the person becomes fully productive is 4.2 million per person. And since we had lost 225 people, their approximate loss for 945 million. Now, if you summarize everything, you'll see that this is the total loss, which is 1.7 billion. And during this period, you would agree that there's certain saving to the organization because those people are not there at their workplace. There's a salary saving. So average salary per employee per day was 1,200, average salary. And we calculated by 225 people, and there were 35 missed days. So 9.4 million was the salary saving, which was quite insignificant. So the total loss for 1.7 billion 746 861075, so almost 1.7 billion. Now, with this background, we try to arrive at certain conclusion. What was the conclusion? That one employee attrition in this organization cost 7.7 million. For that matter, we divided total loss divided by total number of 225 employees. So it gave us a figure of one employee. We calculated that as every employee, since is missing for 35 days, not there at the workplace, so the per day cost of not being at the workplace is 221,000. 1 day employee attrition in financial implication, it was 41. One employee, I think overall was costing you 221,000, and 1 day. 1 day, I mean, the 225 people, when they're not at the workplace for a single day, it was costing 49 million. So these are different ways of looking at these figures. Figures remain the same. 1%, since there was a turnover of 14%, so we are calculating this loss of voluntary turnover because those are the people we wish to retain. So when we calculated this loss, 1% was almost 124 million, and HR, it developed a strategy. During that year, it went for certain improvement by taking certain corrective actions. And with the help of that strategy, they had an impact of 3% improvement. So based on these calculations, the impact of 3% improvement was almost 374 million. Now, what difference do you see over here? That number one is that your alignment, you need a very clear measurable framework with the help of which you can prove or disprove that which is that factor which is improving or deteriorating, which is having an impact on your performance indicators, which is in turn going to have impact on the final composite score. And then how you can translate every element into the financial measures. For example, time to hire. So we could clearly measure that what are the financial implications of a single day for the whole workforce, single day for a single employee. So when you improve the time to hire by X number of days, suppose you have 225 people and you improve the time to hire by just 10 days, so you're saving 2,250 days in 1 year time frame. And you can straight away convert into the financial implications. But keep in mind that in order to do all these calculations, there's certain context, there's a lot of learning involved. They're not straight jacket, keep in mind, because sometimes we think that by picking up, a lecture, we are in a position to do that kind of calculations. Yes, it is possible as long as you can defend it. Yesterday, I was talking to somebody and I was telling that finance people also do all these kind of take assumptions. They do these calculations, average revenue, average cost. But in order to do that, they perform a 4 years of a degree. That means that there's a lot of rigor, a lot of effort involved into understanding the context, translating the financial, the non-financial, the financial things. And then it puts you in a very good position to not only present, but also defend. So with this, this was one part of it. Next thing, I just wanted that you should also be able to relate now that how your organization performance, the workforce performance is complementing the organization performance, whether it is complementing or not. For that matter, there's one more illustration that I've prepared, and this is based on the traditional bell curve. Now, I'm not saying that whether you should be using the bell curve or you should not be using, that's a separate debate. But if you are using the bell curve, then the bell curve says that there should be 5% employees in the outstanding, 10% in the exceed expectations, 70% the meets expectation, 10% in the below expectation, and 5% much below. So the sum of this whole is 100%. Now, as per this distribution, if you have 100 employees, though you may have X number of employees, but for calculation, ease of calculation, we are doing on 100 employees. If you have 100 employees, how this bell curve is going to work? First of all, you need to calculate that what should be the mean rating of the bell curve under this formula. So what you do is that you multiply 5 with a 5, 10 with a 4, 70 with a 3, 10 multiplied by 2, and 5 multiplied by 1. And the figure, the cumulative figure that you get, that is 300. When you sum up all these things, it's 300. And when you further take the average of it, since there are 100 employees, so it gives you a figure of 3. This indicates that as per the bell curve framework, your mean rating should be 3. Now, if there's an organization where you find that people are giving excessive ratings, I mean the overly positive rating, say that your entitlement is just 5% for the outstanding, but the 10% of people have been given, you put in all those figures. Your entitlement for the exceed expectation is 10%, people give 15%. So your entitlement for the meet expectation is 70%, yes, people give 70%. 70% of people are given. Below expectation, logically it should be 10%, but over here people are reluctant to give below expectation, so only 3% have been given, and only 2% people have been given much below expectation. So with this, you would see that now the cumulative figure is 328, and if you divide it, take the mean of it is 3.28. So there's one index which is called Workforce Performance Index, which can be calculated by keeping the actual mean rating of the people on the numerator, and in the denominator you consider the should be. So actual and should be. So in this case, as per this framework, the bell curve framework, 3 is the should be. So you divide 328 by 3, you get 109. So it tells you that your workforce performance index is 9% higher than the required, because had it been 3 by 3, that should have been 100%. So there's no issue. Now the question is, if you have come across this high level of rating, there could be 3 situations. The management agrees to it, or the management does not agree to it. 2 kind of situations. So if the organization has a good performance, and how you can come to know that organization has a better performance, organization also have a performance indicator which is called productivity index. So suppose that this is an organization where your target was 800 million and you could do 900 million. So you divide the 900 actual divided by should be, it's 113%. So in this case, it makes some sense, and you can always ask the top management that since the organization performance is beyond the required standards, so it makes sense that people have contributed. But if the performance, supposedly organization target is 100 and the actual achievement is also 100, or the actual achievement is less than the 100 and you are below the 100%, then in that case, it would not be justifiable. So that means that the line of sight between the organization performance and the individual performance has to be there. If the ratings are being given realistically, then logically it should translate into the organization financial performance. But if the organization performance is not up to the mark, even if you give the high rating, that does not become justifiable. So I'll open the question afterwards very shortly, just to summarize that there are certain success tips in this process, that when you get into the measurement process, one, that as I said, it requires a rigor. It requires frequent effort to understand what should be measured and what is critical and what is non-critical. And also, measurement should be done to an extent it is useful for the decision making. So you need not to focus more on the trivia, on measuring these insignificant things which are not important for the organization. So otherwise you'll get buried under the measurement. And while you deciding these KPIs, involve the stakeholders. Who are the stakeholders basically for whom you are offering service? For example, if you are a business partner and you're working with a division, so you, while developing your KPIs, ask the line managers what they value more. It's the cost, is the quality, is the time. Although they would say everything is important, But practically, you have to distinguish. You cannot say that you have 100% weightage, so give 20% weightage to everyone. That's a central tendency approach. Practically, in our life, we never use the central tendency approach. You would see that on monthly basis, you have certain incomes. So you do not distribute your income on every matter equally. You consider what is more important, what is less important. So same logic has to prevail over there. And final thing is that build accountabilities. Whatever you think is important for the organization, unless you translate into the measurable framework and do not base your performance evaluations and eventually the reward mechanism on this framework, it would not be workable. Now with this, some of the key things that we have discussed in this session, that understanding the organization value chain and what is more critical is very important. Then is the alignment of the employees KPIs with the organization KPIs. Balancing between the volume, time, cost, quality, satisfaction is critical. Differentiating between what is rating and ranking. Keep in mind that 2 people might be placed in the rating 4, but if you have to consider the, you have you have 5% only, suppose that you have 10 people in the outstanding category, but you have to give only, outstanding to the 5 people. So you have to then further see that in outstanding also somebody might be 4.9, 4.2, 4.3. So you small little differences could be made basis for this further differentiations. And final thing is the line of sight between what the organization, the framework you are using for the people performance and how does it relate to the organization performance. So with this, I would like to conclude. If you have any question or the comment, I'll be happy to answer. So I'm now unmuting yourself, everyone. Whosoever already raised your hand. Has anybody got any question? Hello?